Welcome everyone to the Microstructure Exchange. Good to see you all. This is the last session for this season. And today we have Carole Comerton-Forde, who is from Melbourne, but in London for the time being. Great to have you, Carole. Carole will talk about identifying high-frequency trading activity without proprietary data. And Bidisha and Roberto, who are the co-authors, they are here as well. They will be able to take questions in the chat. Before we begin, we have a call for papers out, and the deadline is on Friday. So don't forget to submit your papers. The link to the call for papers is on our website. We also want to mention that our email service is being discontinued. So we will have to switch email server, and hopefully we won't need to ask everyone to sign up for the mailing list again. So we're working on that, and so if you don't hear from us in the coming months, then maybe check your spam filter and see if there is a new type of TME letter in there. I think those are all the announcements. So Carole has asked us to hold back on the questions at least until the first question break. So until then, we can type in the chat. And then when Carole comes to the Q&A slide, we will take questions in voice. So Carole, take it away.
Excellent. Thank you very much, Bjorn. We're very excited to be here to present to this audience and to get your feedback and make all the necessary improvements to the paper. So this is joint work with Bidisha and Roberto, and they're both here. And so they will answer questions in the chat if they come up, but also happy to take questions verbally after the first round of questioning. So this paper is called Identifying High Frequency Trading Without Proprietary Data. In this audience, I almost don't need to bother with this slide, but I figured I would bother with it anyway, just to make sure we're all on the same page. So high frequency trading is a misnomer. It's a very precise term that's used to describe a very large and diverse set of activities and behaviors. So it ranges from liquidity provision, market making type strategies through to liquidity demanding, more opportunistic strategies. But when we talk about high frequency trading, what we're talking about is the use of algorithms, networks, and other infrastructure to initiate, route, cancel, amend, and execute orders across a range of different strategies that are used by proprietary traders. And as the name suggests, speed is obviously key. So these traders are focused on low latency trading. Again, in this audience, everyone knows how important high frequency traders are in markets, electronic markets. So as an example, in equities, in the US, they account for around 55% of trading. In Europe, somewhere between 25 and 45% of trading. And across all asset classes, high frequency traders are becoming more and more important. Maureen has written a really nice paper that sort of summarizes the way in which high frequency traders have impacted markets and how they've changed the way people trade. And some of the notable changes are that trading is in much smaller size, markets are much more fragmented, and so on. So there's been an abundance of research trying to understand high frequency traders. Academics, practitioners, regulators all want to understand how high frequency traders have impacted markets. But our ability to understand high frequency trading has been constrained by data. So why do we need to identify high frequency trading in data? Well, policymakers, regulators, exchanges have designed policies or systems targeting high frequency traders. So think about things like order to trade ratio, fees or limits, speed bumps, minimum resting times. And often those sorts of changes have been introduced in the absence of evidence on how high frequency traders work. So we've improved significantly since the days of Flash Boys, when there was pushes for policy making based on that work of fiction rather than empirical evidence. We have a lot more empirical evidence now, but there's still a lot we don't know. And as an example, I've been spending the last few months in Europe and talking to practitioners. There's lots of concern in Europe about declining liquidity. And some people attribute that declining liquidity to market fragmentation and high frequency trading. But I would question the validity of that assertion. I think there's many other factors that are contributing to declining liquidity in Europe. And to really rule out the possibility that it's high frequency traders causing declining liquidity, we need better insights from data. So what we hope to do in this paper is to give researchers tools to better measure high frequency trading. But what do we know so far from the literature, and how has the literature tried to identify high frequency traders up until now? Because we know there's no comprehensive public data sets. So essentially researchers have taken two approaches. The first is to rely on proprietary data sets. And there's a bunch of those around, but probably the two we know best are the NASDAQ data and also the IROC data, the Canadian regulatory data. And Brogard, Hendershot and Riordan were the first to exploit both of those data sets, but as many people subsequently used the NASDAQ data, and a small number also used the IROC data. And they've given us a lot of really great insights into how high frequency traders trade, but there's limitations with those proprietary data sets. First, they're usually only for a very limited time period and for a limited set of stocks in a single market. So it's hard to generalize from that. Also, the high frequency trader identifiers are typically assigned by the exchange or by the researchers themselves based on characteristics that particular accounts display. So for example, an account that sends lots of messages might be categorized as a high frequency trader. But we know high frequency trading represents many different strategies, and that message traffic variable likely captures some types of strategies better than others. The other approach has been to use proxies developed based on public data. And two really good examples of that are Hasbrook and Saar, 2013, and also Conrad, Wahal and Jiang, 2015. So they've developed tools which are either aiming to identify high frequency traders or agency algo traders by, again, exploring the characteristics of how traders are trading in the market. So they're useful tools, but we don't really know how effective those proxies are at capturing real high frequency trading activity. And that's basically our goal in this paper. We want to assess the reliability of the existing high frequency trading proxies or the existing algo trading proxies to say whether or not they really do capture high frequency traders. So that's our first question. How reliable or effective are the established HFT proxies? The second question we want to answer is whether the proxies capture liquidity demand or liquidity supply or both. And third, do the proxies distinguish between shocks to demand and shocks to supply? And finally, which proxies are better at isolating HFT activity versus other types of traders? And we consider two types, agency algos and also non-algorithmic traders. So to give you the big picture, and obviously I haven't yet told you what proxies we're looking at and so on, so these really are very big picture results. The big takeaway is that all of the proxies that we studied do pretty well. In the literature, people have sometimes used proxies that are scaled by trading activity and sometimes not. So for example, message traffic is a commonly used proxy. Sometimes people just use the number of messages. Sometimes they use the number of messages scaled either by the number of trades or scaled by the dollar volume traded. We find that the scaled proxies are much less effective than the unscaled proxies. In answer to our second question, we find that some proxies are better at capturing liquidity demand versus supply than others, but generally it's hard to disentangle supply versus demand. To answer the third question, we say that all proxies respond more strongly to shocks in supply. so to market making type strategies, then to shocks in demand, so opportunistic type trading strategies. And then again, we find that some proxies are much more effective at isolating HFT from AAT and NAT. So where I want to go to from here, firstly, I'm going to give you information about our context and our sample. Then I'm going to critically tell you about how we go about identifying high frequency trading in our data and what our data look like. I'll define the 8 proxies that we're looking at, provide you with some descriptive statistics, and then I'll dive into the details of each of the research questions and the results to for each question. And then finally, talk a little bit about whether or not you should scale the proxies. But I'll take a quick break there to take any questions if there are any before I get into details.
So does anyone have any questions? Please just turn on your mic and ask. No questions for the time being.
Excellent.
So I think Carole said that from now on you can raise your hand anytime if you have a question, or type in the chat.
Yes, that's great. Thank you, Bjorn. Okay, so we're looking at the National Stock Exchange of India, which might seem like a strange choice, but you'll see the data has a competitive advantage. So at the time of our study, the NSE was the 3rd largest global exchange by market capitalization. It operates a very standard electronic limit order book. So in terms of the trading technology, it's very similar to all of the markets that we usually study. They offer co-location services, which obviously make it attractive to high frequency trading. The NSE competes with the Bombay Stock Exchange using unlisted trading privileges, so very much like the US markets where they compete with one another. But it is much less fragmented than the US. So about 80% of trading is done on the NSE. While it's much less fragmented than the US, it's probably an equivalent level of fragmentation in lit markets as it is in Europe, and similar level of fragmentation that we see in Australia, and in fact more fragmented than most Asian markets. So that gives you a sense, I think, of the how we think about India as how representative it is of other markets. On a spectrum, it's kind of in the middle. It's not as fragmented as the US, in the same range as many of the other markets that we would study. One other difference between India and the other markets we typically study is that there's no dark pools, but there is hidden liquidity on the exchange. So if you think about those 2 factors together, there's obviously some high frequency trading strategies, cross-market arb, strategies that involve arb across lit and dark that are not going to be much less prevalent in our sample than in markets we study. But generally, we think India's a reasonable representation of electronic limit order markets. Our sample is basically the largest 100 stocks on the NSE. They account for about 75% of all of the trading activity. So that comprises the Nifty 50, which is the main market index in India, and then the Nifty Next 50 stocks, which is the next largest index. Our data are a little old, so they're from May to July of 2015. Market intelligence is that high frequency trading was fairly substantial in that time, and we'll show you some statistics on that, but that high frequency trading has grown in the Indian market substantially, and today accounts for a much greater share of activity than during our sample period. There's very active participation of many high frequency firms in India, and many of the names that you'll be familiar with. So there's global firms like Tower, Citadel, XTX, Jump, and Goldman. But then there's also a bunch of local firms. Those names will be less familiar to you as they are to me. We don't know what the mix is in terms of how important the local versus the global are, but our conversations with the exchanges say that they're both substantial players in the market. So turning to the data and how we actually go about identifying high frequency trading for this study. Each day we get a message file from the exchange that captures every new order, cancellation, revision, and trade. And that's recorded with nanosecond provision. The Indian market has one small quirk, that is the way the fee structure is it's more effective for traders to revise orders than it is to cancel and resubmit. So where in the US you'd see a cancellation followed by a resubmission, in India you're more likely to see a revision. So we make some adjustments to our method to take that into account. But that unique code that we see that allows us to track the order history is helpful in tracking those revisions. So we have two flags in the data that are really important for the identification of high frequency trading. So firstly, we can identify orders that are coming from algorithms versus not. And the way we do that is the exchange offers a standard front end to their trading system called the neat front end. But if you're an algorithmic trader who wants to connect and use DMA or smart order routers or other types of technology that would enable you to trade algorithmically, you need to connect to the exchange using a non-neat front end, and you need to register with the exchange. And in the order identifiers, there's a 15-digit field, and the 13th digit of that field has a 0-1 dummy for whether or not this order is coming from an algorithm or not. Okay, so for every order, not the brokerage firm level or sort of more aggregate level, but at the individual order level, we know whether the order came from an algorithm or from a human. So that's the first piece of the puzzle. The second, like many markets, the regulator in India, SEBI, requires brokers to identify whether an order is coming from a customer or is a proprietary trade. So we then also have at the order level an indication of whether it's a prop trade or an agency trade. So those two pieces of information basically allow us to identify high frequency traders. So if an order is both coming from an algorithm and coming from a proprietary account, we consider that to be true high frequency trading. So one other important piece of information to tell you is that we don't have any account level information. Okay, so we can see HFT in aggregate, but we don't know the individual accounts that it's coming from. So it's high frequency trading is a large mass, not individual accounts. Okay. So we're looking at 8 frequently used proxies from the literature. And I think probably most of these proxies will be familiar to you, but I'm going to walk briefly through each of them just so everyone understands the 8 proxies that we're using. So if we think about what proxies are aiming to do, they're aiming to capture the characteristics that we identify with high frequency traders. So if we think first about message traffic, we know that high frequency traders monitor the market actively, they're sending orders frequently and revising their orders in order to manage risk and so on. So message traffic is basically the number of messages, including new entry, cancellations, revisions, and so on, up to 10 ticks or less from the prevailing best quote. So that's messages. Cancellations is the equivalent, but looking only at the cancellation. So any cancellation within 10 ticks of the best price or less. Fleeting orders is a proxy developed by Hasbrook and Saar in their 2002 paper of Ireland. So that's basically looking for orders that are cancelled within 100 milliseconds of submission. So we've modified the time horizon relative to what Hasbrook and Saar have in their paper, because the market obviously is much faster in 2015 versus the pre-2002 data that they're looking at. IOC is another important variable, I think first used in one of Eric Bidisha's papers. Essentially, an IOC order is an order that has special instructions to immediately cancel the order if it's not fully executed. So the order gets submitted, partially or fully executed, and the remainder gets cancelled. So it's about trying to conceal the footprint the trader might have on the market. And that's obviously something that high frequency traders are trying to do. Speed of response, also a Hasbrook and Saar measure, is essentially the number of responses in the limit order book with 100 milliseconds of an NBBO improvement. And there's a bunch of responses, so essentially changes in the order book in response to that NBBO price improvement. I won't read them all out, but it's essentially trying to capture changes, how people are responding to a change in the NBBO. And I haven't put that up. So essentially, again, that's trying to capture how quickly are traders responding to new information as a result of changes in the order book. Strategic runs, again, Hasbrook and Saar, is essentially looking for linking orders together that might be part of an algorithmic strategy. So they're linking submissions, cancellations, and executions when they seem to be related to the same strategy. And here, because we have this revision difference in the market, we spoke with Gideon and Joel, and they agreed with us that incorporating the revisions into the context of this measure was important given the institutional detail in India. So essentially, the strategic run starts with a non-marketable order, and then it gets revised within 100 milliseconds in the same direction and the same size, adjusting for any partial executions that might have happened. And so you can have these strategic runs that run over a long period of time as people are adjusting their orders.
So, Carole,
yes.
you might think that we're awfully silent here, but it's lively in the chat, and I'll pick up a question from the chat, though Roberto and Bidisha have handled some questions. So Marius Panagides is asking, why don't you also test the odd lot activity proxy? This is one of the Midas measures.
That's a good idea. Actually, Bidisha might be able to help with that. I don't believe India has odd lots. Am I correct on that statement, Bidisha?
I would say you are correct, but I will have to check back. I don't want to say anything that I'm not 100% on, but I do think they do not allow odd lots.
Yeah. Okay. Thank you, Marius.
Thank you.
Okay, the final two measures, quote intensity. So this comes from the, Conrad et al. Paper. So they're essentially looking at the number of changes in the bid and ask price or bid and ask depth. And the last measure is flickering quotes. So this is looking at the standard deviation of midpoint price returns over very short horizon, so 100 milliseconds. So again, if the high frequency traders are adjusting their quotes very quickly and impacting the NBBO, then that will lead to a high standard deviation in the midpoint prices. So those 8 measures are sort of the ones that are most commonly used in the literature. The first 6 require very granular message data, but these days that data is pretty generally available in most marketplaces. The last 2 measures only require quote data. So a good outcome would be, these last 2 measures do just as well as the message level data, in which case people could rely only on quote data. Unfortunately, that's not the case. Typically, the message data is better, but in some instances, the quote level data is fine. So I'll go into more detail of when that is and when it's not true. Okay, so that gives you the setting in terms of what variables we're interested in and we're going to measure. To give you a sense of how much high frequency trading activity there is in India during our sample period, I'm just presenting you with some summary statistics. So high frequency traders account for about 33% of all trades. They account for about 25% of trading volume. So this is equivalent to what we see in, as I said, Australia and Canada and Europe. They account for a much higher fraction of messages. 50% of limit order submissions and 2/3 of cancellations. We have 3 measures of HFT liquidity supply in the order book. The first one, CB quotes, is the contribution to book quotes. So that's telling us the fraction of time high frequency traders are at the best price on one or both sides of the book. So they're almost 50% of the time. and then their contribution to depth. So they account for about 25% of the depth displayed at the best prices and about 25% of the depth at the best 5 prices. So they're pretty substantial players in the market. So they're the statistics for the sample overall. We get slightly higher shares in the Nifty 50 versus the Nifty Next 50. And yeah, comparable to Australia, Canada, and Europe, but lower than the US. Okay, so big picture empirical approach. We are going to compute all of the 8 commonly used proxies over intervals ranging from 30 minutes through to daily. And we're going to calculate 2 versions of each proxy. We're going to start by calculating what we call the true HFT metric. This is where we rely only on the messages and trades that are coming from high frequency traders as defined by the 2 identifiers that I described to you. The second time we calculate the proxy, we're going to call that the proxy metric. And that's calculated using all of the messages available. So this is basically equivalent to what people are generally doing in the literature, right? They don't have identifiers, but they're using these proxies as an indication of high frequency traders. Then we're going to compare the true and the proxy metrics to see how well the proxies stack up. Then we're going to consider the true measures of HFT contribution to liquidity, supply and demand, and compare those contribution measures to the proxy metrics, again, to see how well those proxies stack up in terms of capturing true HFT activity. Okay, so turning to the first question, how reliable are the HFT proxies? We're going to start by calculating the correlation between the true and the proxy metrics. So we're going to regress each per stock standardized metric on 15 25-minute interval dummies. And we use the 25-minute interval dummies to basically get rid of an intraday deterministic pattern. And then we're going to use the residuals to report Spearman correlations. So this table is very busy, but just focus on the colors. So this is basically the Spearman correlations for each of the 8 proxies calculated over different time intervals. And the very dark blue means the correlation is above 90%. And then the shades of blue as they get lighter indicate lower levels of correlation. So you can see all of the proxies are all pretty correlated. But what seems to be best is the message and cancellation, the strategic runs, and speed of response. And in particular, the messages and cancellations seem to do well at all time intervals, versus some of the others do better at some time intervals than others. The other thing we do is look at the correlation between the different proxy metrics, and they're also very highly correlated across the board. Okay, so second question is, do the proxies capture demand or supply? So we've got 4 measures of liquidity supply and 1 measure of liquidity demand. So for liquidity supply, we first think about how often the high frequency trader is on the passive side of a trade. So that's CMake. And the equivalent on the demand side is what's the percentage of trades where the HFT is on the aggressive side of the trade. Then in terms of supply in the order book, we're using those 3 measures I described before. So the percentage of time they're at the best prices and their share of order book depth. So we're going to estimate pooled regression models for each proxy metric on the true HFT contribution to liquidity, supply and demand. This generates a massive number of results. So I'm not even going to try to summarize them on a slide. I find it overwhelming. So I'm just going to summarize the results for you verbally. So basically, all of the proxies capture changes in all of the measures of HFT contributions to liquidity, supply and demand. Okay, so they're capturing both supply and demand, no matter how we measure them. We then think about, well, does it work in periods of very high liquidity, high HFT activity, liquidity, supply and demand, where high is the top 25% and low is the bottom 25%. And again, what we find is that all proxies continue to capture both supply and demand. And the highest levels They show the highest levels when both supply and demand are unusually high, and conversely for low. So it's pretty difficult to distinguish between supply versus demand. But one small insight is that the speed of response measure, followed by cancellations, are the most responsive proxies based on that analysis. So it's not really that surprising that demand and supply seem to be very tightly interconnected. We know from the literature, so Marius and Albert's work shows us there's interactions of supply and demand increase with speed. Terry and Ryan, we know that HFT are more likely to take liquidity when there's lots of liquidity available and provide it when it's scarce. So what we want to try and understand is what causes what. Is the demand causing the supply or supply causing demand? And we do that by doing Granger causality tests. We use the bivariate vector order regressions to model the interaction between true HFT demand and true HFT supply. We do that at a bunch of different horizons and estimate an orthogonalized impulse response function of a bivariate structural var. Again, this generates lots of results. So I'm just going to pick a few examples to report to you. The results are very consistent across the different measures. So if we think about liquidity supply using the C-make measure and liquidity demand using the C-take measure, what we can see from that plot is that shocks to true liquidity demand lead to changes in liquidity supply. But if we focus on the red line, obviously that shock has a much bigger response versus the shock to demand. So the accumulated responses are statistically larger for shocks to supply than they are for shocks to demand. And as I said, this is consistent across all of the different proxies that we look at, the different contribution measures that we look at. Then we want to relate that to the proxies themselves. Okay, so we want to estimate an impulse response function of the bivariate S var for each proxy metric and the true HFT contribution measures. So again, just for illustrative purposes, I'm going to show you the results for the cancellations proxy, where we're measuring supply with the contribution to book quotes and demand with C-take. And again, what you can see, both proxies respond to both demand and supply shocks, but the responses are statistically larger for shocks to supply. And again, this is consistent across all of the alternative measures that we have. So basically the takeaway from the results in answer to question 2 is that it's very difficult to disentangle liquidity supply versus demand shocks. But now we want to see whether HFT proxies can distinguish between shocks to demand and supply. And we do this in 2 ways. So we run some logit regressions ranking stocks based on their true contribution to demand and supply. And we also do principal component analysis. In the interest of time, I'm going to only present the logit regression results, but the PCAs generate some nice plots which are in the paper and worth looking at, and the results are consistent. So I'm only going to present the logits. So essentially what we do here is we're going to run a pooled logit regression where we're going to identify a stock as being in the top category, so it gets a dummy variable of 1, if the stock falls in the top 3 deciles of true contribution to HFT, or true HFT contributions, and 0 otherwise, right? So that's how much activity is actually coming from high frequency traders. Is it in the top decile or not? And then we're going to look at a dummy variable for whether the HFT proxy is in the top versus the bottom, and regress one on the other. And the regression also has day of the week dummies. Yes, Josh.
Hi, Carole. Just conceptually to try to understand kind of where you're going with this question, I was wondering if maybe you could say a little bit more about conceptually how to think about what a shock to either demand or to supply would be, like what would, just so I can have like one example to think about.
Yeah, so I guess it's just an increase in the level of activity coming from a high frequency trader. I guess we're not trying to identify what the source of that increase is, just an observed increase in that activity, either on the demand side or on the supply side. Don't know if Bidisha or Roberto, if you want to add anything to that.
So could this be like the entry maybe of like a new HFT who specializes in, say, supply but not demand, or something like that? Would that be an okay way to think about?
Not really, because we're looking over, it's increases over the 3-month period. So during that period, it's not like we're observing a new firm coming in. It's that within a day, for example, their activity is changing over time, or from day to day, their level of activity is changing. Does that make sense?
Yeah, I guess I was just trying to think through what might drive a change like that. What might be the underlying driver?
Yeah.
But maybe that's not important for where you're going here.
Yeah, I mean, market conditions are going to be a driver. Yeah, we'll give some more thought to that question, I think. I don't think we have any new entrants into the market during our period. And even if we did, we couldn't identify those because, as I said, we don't have any account information. But yeah, so we're looking at a shock to aggregate HFT activity, right? Not an individual firm.
Thanks.
Okay, thank you. Okay, so I'm going to show you the results from that regression for an odds ratio for the beta coefficient. In the paper, we also report some marginal effects. But again, in the interest of time, I'm going to just do the odds ratios. So what you can see here is we're reporting for each of the proxy metrics, the odds ratio for the 4 measures of liquidity supply and liquidity demand. And so if you focus on that first cell, the 1.39, what that's telling us is that a stock ranked as top by the C-take measure has an odds ratio of the stock truly being in the top 3 deciles by true HFT demand, changes by a factor of 1.39, with all other variables being held at the average values. And so if we sort of focus on that C-take line first, you can see that IOC has the highest coefficient and also the most statistically significant result, telling us that IOC is the best at identifying high frequency demand. Okay, fleeting orders also seems to do relatively well. Quote intensity, there's no statistical significance. If we focus on the next 3 lines, which are all of the liquidity supply measures, what you can see is that speed of response seems to be best across all of those measures. So again, highest coefficients, highest statistical, or the highest statistical significance. So speed of response seems to be the best proxy for capturing a shock to liquidity supply. Quote intensity and flick, so the 2 measures that are only relying on quote data seem to be doing pretty well as well. Okay, so if you're wanting to capture shocks to liquidity supply, they're your best bets. You can do that reliably with the quote-based data. But if you're wanting to identify liquidity demand, you can't rely on the quote-based data. You need to have message level data, and ideally that IOC indicator. Okay, so I've only got a little over 5 minutes left, but I can take some questions if there are any before I move on to the last question of isolating HFT from AAT. But if there's no questions, I can just move on.
I guess there are no questions at the moment. So
okay,
let's do the last bit.
Okay, great. Okay, so what proxies are most successful at isolating HFT from other types of activity, and specifically agency algos and non-algo traders? Some of the proxies that we've looked at have been used in papers to identify AAT rather than HFT. So, how effective are they at those different types of trading activity? So we know that AAT use very similar technology to high frequency traders, but their objectives are quite different. Okay, so they're using limit orders to reduce their trading costs rather than to try to profit from the spread. They're using algos to try and minimize their trading footprint rather than to make markets or pursue opportunistic strategies. They're generally one-sided rather than two-sided, and generally less focused on latency, but they exhibit a lot of similar patterns to HFT activity. So it's not necessarily straightforward to isolate the two with a single measure. When we look at the proxies, what we do first is to try to see which trader type contributes most to a given proxy. Okay, so this table is basically telling us how much of each trader type contributes to that proxy. So if we focus on the first line of messages, it's telling us that almost 54% of messages are coming from 54% of the message proxy is related to HFT, and that's statistically different from algo traders where it's only 33%. The proxy that seems to be most different in terms of across the categories is strategic runs. So 75% of the strategic runs measure is coming from high frequency traders, compared to only 26% for AAT and nothing for non-algo traders. So quote intensity, in contrast, is just as likely to reflect HFT as it is to reflect AAT. So this is starting to give us an indicator of which proxy is going to be better at identifying HFT versus algo. So the next thing we do is to see whether the proxy metrics correlate with the analogous true metrics calculated using the AAT indicator and the NAT indicator. And so first, if we compare HFT against AAT, what we find is these are very highly correlated across the board. So somewhere between 47% and 90% correlated across the different proxies. But the lowest correlation is observed for strategic runs at only 47%. So that's telling us that strategic runs is the best measure for isolating HFT from AAT. Speed of response has a 90% correlation, so it's the worst measure for isolating HFT. When we compare HFT against NAT, there's still, somewhat surprisingly, significant correlations across all of the different proxies, but the magnitudes are much, much lower. But the pattern is the same. So again, strategic runs is the best for the isolation, and speed of response is the worst. We look at this more formally by doing a two-stage least squares regression, where the first stage of the regression is a stock-by-stock HFT true metric regressed on the AAT or NAT true measure. And in the second stage, we include the first stage residuals on the corresponding proxy metric. So essentially, the residuals from the first stage is the component of HFT activity that's not correlated with the algos and with the non-algo traders. So I'm just going to show you the results for the HFT second stage results. And what you can see, I'm reporting the coefficient from the regression, also the t-statistic and the R-squared. And what you can see is that strategic runs has got the biggest coefficient and also the largest R-squared. So it's again showing to be the best measure in terms of isolating HFT. Flick is doing the worst. So it has the lowest coefficient and also a very low R-squared. If we look at strategic runs, AAT and NAT have much lower coefficients and negligible R-squareds. And Flick has got, for AAT and NAT, much higher coefficients and equivalent or higher R-squareds. So again, the takeaway from this result is that strategic runs is the most effective measure at isolating high-frequency traders from algo traders. Okay, the last thing I want to do is just talk a little bit about whether or not we should scale our proxies by trading activity. So as I mentioned at the beginning, the literature has used both, and generally there's not a good justification of whether you should scale or not. I think people have made choices and they've become conventions, but we don't really understand whether they improve the proxies or not. So all of the proxies you'll notice so far I've presented are unscaled. So now we're going to do some analysis of some of the scaled equivalents of those measures. So the most commonly used or well-known is probably the Hendershot, Jones and Menksfeld AAT proxy. So they're using number of messages scaled by dollar volume. Boehmer, Fong and Wu have an equivalent proxy for quote data, where they're looking at quote changes scaled by dollar volume traded. And then we've also frequently seen quote to trade ratios and cancel to trade ratios. So we're basically going to examine those scaled measures using the same techniques I've just walked you through. So the correlations between true and proxy, the correlations between HFT proxies and other traders, and then the two-stage least squareds of the HFT versus the other traders. And what we find is that the scaled proxies still continue to produce statistically significant results. So they're doing okay, but they're worse across the board than the unscaled proxies. So just to give you a sense of the order of magnitude of that, so correlations of the true to proxy results range from about 12 to 55% for the scaled measures, compared to the 51 to 95% that I showed you for the unscaled measures. The correlation of AAT true versus HFT proxy ranges from 21 to 62% for the scaled versus 47 to 90% for the unscaled. The quote to trade ratio and the cancel to trade ratio, so the measures that are being scaled by number of trades rather than dollar volumes, do better at isolating HFT than the ones that are scaled by dollar volume, but they don't do as well as their equivalent unscaled measures. So our takeaway from all of that is, if you're trying to proxy high frequency traders using public data, don't scale the measures, just use the raw message data or the raw cancellation data. So wrapping up, just a couple of minutes behind schedule. We've looked at commonly used proxies for HFT and shown that they're reliable across the board, but some are more reliable than others for specific tasks. So if you want to identify liquidity supply, speed of response should be your go-to measure. If you want to identify liquidity demand, it should be IOC. Strategic runs are best at isolating HFT from AAT, and speed of response is particularly bad at that. So if it's really important that you want to identify high frequency traders and not algos, don't use the speed of response measure. Disentangling demand and supply is very difficult because they're interrelated, but the proxies are much more responsive to liquidity supply than demand. And we think that's probably not that surprising given the way the proxies have evolved and the way we think about high frequency trading often being about market making. And that's much easier to identify in the data than liquidity demand. Where message data are not available, you can use flick and quote intensity to measure high frequency liquidity supply. But we recommend that you don't try to identify liquidity demand if you don't have message level data. And then when using public data, don't scale your HFT proxies. So I'll stop there and open up for more questions.
Thank you very much, Carole. Really interesting presentation. We have a couple of questions from the chat. Marius, do you want to ask your question now?
Yeah, thanks, Bjorn. Very interesting talk, Carole. One thing that's not 100% clear in my mind is, why do we want to disentangle between supply and demand at the general level? I understand account by account, we would know who is supplying, who is demanding. But in my mind, markets would sort of flicker around between being calm or being frantic, and when they're frantic, suppliers respond to the threat of the demanders coming along, right? Like if we think, for example, of latency arbitrage. So it's not surprising in my mind that you cannot disentangle them.
Yeah, thanks for that. I hope many people share your view, because that will make our life much easier. I mean, I guess we initially, that was a goal to try to disentangle. And the more we digged into it, the more we realized that, yeah, the two are just so interlinked. It's very difficult to do. But we still nevertheless want to try. But as you can see, and as your intuition tells you, they are very related.
Thanks.
Albert.
Yeah, I second Marius' point that it's super interesting to look at all these things. But immediate questions, and I thought give all of this more thought. The immediate questions are, why is the time to response slower for HFTs? If I understood that result, so it seems like you're finding that the non-HFTs are faster to respond than HFTs, and that to me is calling for an explanation. I don't know what that means. I'd expect it the other way. And the other thing I'd encourage you to think about is the fee structure. You mentioned it in passing, but all of these things are so dependent on the fee structure. So before applying any of these measures, you want to make sure that whatever market you're looking at has a similar fee structure to the Indian exchange, as otherwise agents adapt, I think. So those were my things that immediately came to mind. But thanks for doing this elaborate approach. You've been doing lots of the calculations, I'm sure.
Excellent. Thanks, Albert. They're both really good suggestions for us to think about, but I don't think I have immediate answers for either, unless Bidisha or Roberto want to jump in.
I just have a clarification to ask, Albert. Did you say that you took away that the speed of response was slower for HFTs?
Yeah, maybe I misunderstood. I thought that the time to respond was not a good proxy for capturing HFT activity. So whenever things are responding, when time to response proxies go up, it seems it's not the HFTs that are active there, but it must be the non-HFTs then.
No, actually, the speed of response metrics was quite well when it in terms of identifying liquidity supply by high-frequency traders, so variations in liquidity supply. It doesn't work if you try to capture variations in liquidity demand, but it's a valid proxy.
Ah, okay. Right. That makes a lot of sense to me already. But it, all of this, when you started talking, I was immediately a bit in what Marius was also thinking about the Bidisha friction. That whenever there is public news, it's this runs for those HFTs that have quotes out to change their quotes, and for those that don't, they're on a run and take the stale quote, and then they impose a cost on one another. And so is this, and I think you have a way of identifying how much of this activity is of this kind versus another kind, where HFTs are adversely selecting non-HFTs who have a quote out, or otherwise HFTs are being adversely selected by non-HFTs. So that, I think it's worth thinking through this, and it might actually be a punchline or a punchline result for your analysis, that you have yet another data set to see how much maybe of the Bidisha type of activity is part of the total HFT activity. Anyway, I'll stop here. I don't want to monopolize this discussion. As you can see.
Yeah, they're very helpful comments, Albert. Thank you. We'll give more thought to that. I think Andre was next. Was he, Bjorn?
Yes, Andre.
Thanks, Carole. A very interesting presentation and paper. I think we're all curious about the same variable, which is the speed of response. So right now, it is very surprising that particular variable doesn't distinguish very well between non-HFTs and HFTs, because with a 100 millisecond window that you guys are looking at to measure that, you would expect manual traders not have enough time to respond, but they seem to respond somehow. So I was thinking it could have to do with the way the exchange identifies those NATs? And this is where I was hoping to ask for some clarification. So are NATs everybody who is not an algorithm, or are they everybody who is not using the exchange's speediest?
So I think you sort of muted there before you finished talking, Andre, but I think I got your question. So it's not the NATs that are fast, it's the AATs are fast. So yeah, we're having trouble distinguishing between, on the speed of response measure, the AATs from the HFTs. So it seems like the agency algos are also able to respond quickly. Roberto, did you have anything you wanted to add?
No, that's the issue.
Yeah.
So I might have misunderstood then the slides. So you guys are saying that the metric, the speed of response metric, distinguishes NAT and HFT well.
That's right.
Yes.
Okay. My bad then.
Peter.
Hi, I just kind of missed the slide 33 about the difference between agency algorithmic trading and the high frequency trading. So can you comment more, because it was in the end and it was kind of rotated very fast.
Okay. Oops. So this is the one you had in mind, Peter?
Yes, yes.
Yeah. So I guess here we're just trying to give some motivation as to why we might want to disentangle and why we might have trouble disentangling, right? So the way the market has evolved, AAT are using similar technology to HFT these days. A little bit less so back in 2015, I guess.
But it's not clear for me, for instance, use limit orders to reduce trading costs rather than profit from spreads. It kind of conflates in my mind the difference. Right?
No, I'm not sure I understand the question.
If you reduce spreads, you reduce trading costs, and if you profit from spreads, you also reduce spreads. Strive to reduce spreads. It seems to me tautological.
Okay, no. So we're thinking about, I mean, when an institutional investor is trading and using algos to do so, they have a choice as to whether they want to use market orders and cross the spread, or whether they want to trade passively and use limit orders. So their algorithms are making choices about how patiently they want to trade. And that will be dictated by a whole bunch of factors, you know, how important their information is, how time sensitive the information is, and so on. But generally, if they can trade passively and post limit orders that get executed, their trading costs are going to be lower than if they use market orders and cross the spreads. So that's the way we think about AAT and how they're using algo technology. Whereas a high frequency trader is posting two-sided limit orders in the market, not because they're trying to trade patiently and have a particular view on where the stock price should be, but they're simply trying to earn the spread. So they want to make the difference between the buy and the sell side of the market, whereas the algo is only trading on one side of the market, right? They're a one-sided trader trying to accumulate or decumulate their position. Does that make sense?
Oh, yes, it's my misunderstanding. But now I'm conflating item 3 with item 1. But again, I'm finished. Yes. Thank you very much for answer.
Okay. Thank you. Andre.
Was hoping to ask one more. So you guys are saying scaling is not the right way to go. Do you know why? What is it about scaling that messes things up? Because, you know, naturally one would think to compare in the cross section, you would need to scale to adjust for, you know, low volume stocks.
Yeah, so we don't have a perfect answer to that question, but our intuition is that the denominator is including trading volume and or number of trades from all traders rather than just high frequency traders. And so it's just adding more noise to the proxy. Whereas if we're thinking about messages, for example, the most of the message traffic is coming from the high frequency traders. And so that's sort of a slightly cleaner measure. That's the intuition we have. If other people have got other thoughts on an explanation for why the unscaled measures seem to perform better, would certainly be keen to hear it.
And in the cross section, just a quick follow up. In the cross section, are the results pretty stable across the entire 100? Okay.
Yeah, they are. They are. So we've done tests of top 50 versus the bottom 50, and you know, the results hold up for both subsamples.
If I may add to Andre's question there, I think there is a pretty nice intuition for scaling by trading volume, that for example, if there is volatility, everyone will quote more. So you risk capturing volatility if you take only the number of quotes. So then dividing by trades has a good intuition if we think that HFTs have a high number of quotes relative to the trades. Also relating to there was a question before by Vincent van Kervel in the chat. If you're controlling for volatility somehow, so that to make sure that your measures capture actual HFT activity rather than volatility.
Okay.
Can I just jump in quickly? I think these are really good comments. But like we were trying to answer in the chat, Bjorn, you know, in many of our tests, we are tracking whether the proxy is a good measure for the true. So it's the proxy and the true at the same time. So the market conditions are the same at the same time. So that was sort of our reasoning for why you don't have to control for the market in those tests. But I mean, I just wanted to make sure that we thought about it, and we thought, you know, if the question is how the proxy and the true vary at the same time, that's why those controls were not there. But I think these are good suggestions. And in those tests where we are just testing the performance of the proxies, their market conditions would be really important.
Thanks, Bidisha. We have a question in the chat from Yang Yu. Yang, do you want to ask your question in voice?
Oh yeah. Thank you so much, Carole, for your presentation. Yeah, I just wondered that which variable proxy for aggressive HFT better, except IOC, because IOC is the message level. But if I have order level data, then I do not. I mean, I can't specify which order is IOC, or I really couldn't identify this IOC message. So yeah, so I just wonder that except this measure, what is the second best measure to a proxy for aggressive HFT? Thank you.
Yeah, that's a good question, because you're right. IOC is less frequently available than other messages. Off the top of my head, and Roberto, jump in if I get it wrong. I think the next best measure is the speed of response. Is that right, Roberto?
Our PCA analysis that we have not shown in the presentation, but is available in the paper, you can see that we find a principal component in the proxies that is highly correlated with demand by high-frequency traders. And in that component, the second proxy with the higher loading after immediate or cancel orders is cancellations.
Oh, interesting. Oh, thank you.
And any other proxy that is that depends on or is intensive in message traffic.
Okay, thank you. I will think about it. Thank you.
Albert?
So we have Albert and Andre in the queue again.
I jumped Andre. One thing at a maybe a somewhat deeper level, why are we so interested in tracking HFT activity? Shouldn't it be the other way around, that HFT is a proxy for example, aggressive, toxic limit order or market order messages, or anything like that I would care about first. If I look at the market from an outside point of view, I care about what my order that I put out there interacts with. If there's any toxic, fast market orders that take off the pick of my order on public news or whatever, I don't care really if it's coming from HFT or non-HFT. I care ultimately about my results. And so this puts the whole thing upside down. And this is just to provoke your thinking about this. But then you would say that this type of activity is more important than whether it's coming from HFT or not. And so if you have an HFT proxy, you have a proxy for what you really care about, which are the types of measures maybe that you report. Do you see what I mean? I mean, it's just a thought.
Yeah, no, that's a very good comment, and it's something we've talked about. And I don't disagree with you that what people care about is who they're interacting with and whether they're getting good outcomes or not. Why we think it's useful to identify high frequency traders in particular is because often that the regulators are focusing on a class of traders, right? So when you see regulatory reform, it's often around high frequency traders rather than the specific behaviors. And so that's why we think it's useful to identify them. And the fact that they're sort of targeting a class of trader rather than a behavior is maybe that's problematic.
I would say that we have something to battle against. This is just outrageous. That it's like discrimination. Because you're an HFT, you get special treatment. No, I think it's wrong. This is not in the spirit of inclusiveness and everything.
Okay.
Anyway, this is but you got what I was saying, and it pleases me that you've been thinking about this the same way as I started thinking about it. Anyway, it was useful. Thanks.
Okay, thanks, Albert.
Can I go?
Yep.
So since we switched to general questions, I was waiting with this one. It was interesting when earlier Bidisha and Roberto wrote in the chat that the National Stock Exchange of India charges per bandwidth. So basically, if I'm a market maker and I need to submit a lot of quotes and change a lot of quotes, I pay the most. Is that right?
I might defer to Bidisha on that.
I'm not sure about pay the most. If you know your usage, you buy the right amount of bandwidth.
Mm-hmm. I'm just, this kind of brought me to think back to the Toronto Stock Exchange experiment back in 2012 when they started charging for the number of orders submitted to the exchange. And they immediately found out that the traders who submit the largest number of orders are the market makers. So liquidity deteriorated. And since then, I've sort of been trying to think, so which exchanges charge for what? And charging for order submissions is, from what I understand, relatively rare because everybody understands that that's what market makers do. So it was interesting to hear that this exchange seems to charge more if you're more active. But I wanted to confirm that I understood the bandwidth point correctly.
Yeah, so what I can tell you is that, traders will buy a fixed amount of bandwidth, and then if they cross that bandwidth, they go to the next. It's a tiered pricing structure for fees. And if you know your usage, which presumably these traders do, you have the right amount of bandwidth, and that's it. You will not come up against that.
How do they measure the bandwidth?
How
I
do
want measure, what is the measure of the bandwidth?
I presume like we do when we order internet services in our homes or so on, if you're, when you're contracting with an internet service provider, I mean, I don't know exactly, but I would assume that, if you're doing a lot of upload and download from your home, you're going to invest in infrastructure, including bandwidth that allows that.
Right, but it can be measured in different units. I cannot even understand what units Indian Stock Exchange uses to measure the bandwidth. Okay.
I can definitely find that out.
This is just sort of thinking about something else potentially to do. If these are sizable fees, if bandwidth costs nothing, then forget it. But if these are sizable fees, would be interesting to see what happens there when they change the cost for bandwidth, for example, and whether that affects anything in terms of liquidity provision.
That's a very interesting follow-up. Thank you, Andrew.
If I may add something, the data we have, at least the data we have, does not include trader IDs. So we cannot track individual traders' changes in behavior, unfortunately.
Although I think Andre's suggesting if there's a change in the fees that they charge, which again would require new data, because during our sample period that didn't change. But if there was a change, then we could get data for a later period. I think that would be a useful thing to explore.
Mm-hmm.
Okay, are there any remaining questions at this point? I think it's been a very exciting session. Thanks, Carole and Bidisha and Roberto for coming, and everyone in the audience as well. And as I said in the beginning, we'll take a break at TME now, and the call for papers has its deadline on Friday because we plan to come back. So don't forget to submit, and we wish you happy holidays eventually, and we will be back in February or March.
Thanks very much, Bjorn, and thanks everyone for your comments.
Yeah. Thank you.